Hello and welcome. US President Donald Trump has recently said, and I quote, I will always be friends with Modi. He is a great prime minister. India and the United States have a special relationship. There is nothing to worry about. Now, Prime Minister Modi responded to this on X and said, look, I deeply appreciate and fully reciprocate President Trump's sentiments and positive assessment of our ties. India and the US have a very positive and forward looking, comprehensive, and global strategic partnership. Well, what does all of this mean for the stock markets, not just India's, but globally, India's economy and the world economy, gold, oil prices, and the currency going forward? Well, to decode all of this, I'm joined by senior economist Mitali Nikore. I'm also joined by senior market analyst G Chokkalingam, also the founder of Equinomics Research. Thank you both for your time. Mitali, what do you make of this statement and India US ties, as well as the impact this will have? This is, remember, the first positive signaling by India and the US ever since the tariff tiff, in a sense.
No, absolutely, Sakshi. I mean, this was a very, I felt a very emotional note that, that sort of came out from the president's, computers or phones or wherever he tweets and writes from. Because for the last few, messages that we've been receiving, the tone has been sort of hostile sometimes, and sometimes it has been, perplexed, but this is the first time that such an emotional note has come. And also I think the note is very much targeted at his friendship and his bilateral relationship with the prime minister, with Prime Minister Modi. It's not so much an India US discussion. He said that the India US discussion is separate and the relationship with Mr. Modi is separate. So he's kind of creating that separation between the two. I think this is his way of keeping the back door open, sort of signaling that he remains open to negotiations, to discussions, to take things forward. But his stance on the tariffs is separate from somewhere his relationship with Mr. Modi. So I think we have all become, analysts of how he feels, and somewhere there is this impact. But the issue is that all of these things end up impacting growth, they end up impacting economies, and they end up impacting the lives of millions of people beyond just these two people who are in a relationship. And at the end of the day, when we look at the impact on the GDP, the chief economic advisor has just issued a statement 2 hours ago that the impact on India's GDP could be as much as 0.5 to 0.6% within the next financial year if these tariffs are not revoked or not withdrawn, and the negotiations don't take place, or if the India-US trade deal doesn't take place. So, there is that fear. And then, of course, these fears feed into the markets, into the market sentiment, into the investor sentiment that if you're coming to India, is it really, the best sort of option? Are you going to get those returns that were promised? So, somewhere, I think all of these things add up, and that's what it really means for the overall economic sentiment.
Right, that's as far as the economic sentiment goes. But G. Chokkalingam, sir, what does this mean for the stock markets? What does it mean for gold prices? We have seen gold prices hit a record high after high. The precious metals, silver and gold included, hitting record highs. We've seen the rupee depreciating. We've seen oil prices trade in a range-bound trade, more or less, and we've seen that India's stock markets have been trading marginally higher today. So, for those wondering, okay, what does this mean for stock markets going forward? What will it mean for commodities going forward? Your first thoughts.
Yeah, this gesture between the two leaders of US and India is a big relief for analysts like us. It gives a tremendous hope that things could change in favor of India, because we can manage the goods exports impact on the market and economy, because GDP might fall 30, 40, 50 bips, and market also can manage because the goods export is not dominant in our economy.
Right.
However, there were signs of some disruption to service exports. If that happens and that becomes part of the trade tariff war, then that would be very risky, because ours is a primarily service economy, and manufacturing accounts for only 17% of the total GDP, and within that, export of good is not a dominant one. So This gave us a lot of fear in the last few weeks, the possible disruption to service exports. And this
Yes.
has come as a big relief. And I believe, since India exports nearly 140 billion worth of services, IT services to US,
Mhm.
this is a really, really great relief. And I believe both economies will patch up, and the free trade agreement, as the commerce minister also indicated earlier, would be signed by November, and that should be a great trigger for the markets, because we already have a good monsoon, inflation low, reversal of interest rate cycle is also very much possible. Oil prices also already down 20%. Then you have a GST reform. Before that, you had an income tax concession. So all this would converge into a strong recovery in the market. Even the FAIs would come back starting from the Q3. So I'm pretty confident that based on this gesture, things are likely to change in favor of Indian economy and markets very soon.
All right. So, based on this gesture, Mitali, do you agree with Chokkalingam, sir, that look, things are likely to change far, far, far for the better? And also, really, as far as the markets are concerned and precious metals are concerned, the currency is concerned, we have seen how each one really has responded to the events over the last few months. So, your thoughts really on what this positive signaling then means for the equity markets, for commodity markets at large?
So absolutely, Sakshi, and of course, sir is right. I mean, investor sentiment is very quick to change. So when they see that there are some positive headwinds, definitely the investor segment, will take it as a positive sign, and we'll start to see that built into the market expectations. However, I would like to caution that there is a difference between the impact on the real economy and what the markets are taking into account. So in the real economy today, when we look at it, the tariffs are in place, and we are speaking to a number of associations, industry associations, and textiles and leather, footwear. We are speaking to people in chemicals, we are speaking to people in gems and jewelry, and they are feeling the impacts at this moment. Of course, they are also hopeful that with these signs that there can be a negotiation and this can be a short term impact, but at the same time, the jobs of some of the workers, especially the contractual workers, order cancellations, these are still real impacts which continue to happen in most of the MSME segment. Now, when that goes into the stock market side is looking at a more macro picture. So they're saying, okay, maybe this is just a small blip. It's 0.2, 0.3, 0.5% of GDP in a country which is growing at 7.8%. Right. So for commodities, for markets, this is just a small blip. But at the same time, we must remember that for MSMEs and for women workers and for marginalized workers, this is a real impact on their lives. So I think both of them are a little bit separated. And I do think that, of course, for equity markets, for debt markets, even for commodities, if the positive signals continue, definitely they will be bringing it back, and the cycles will start coming back, and it will be more like a cyclical impact. But if the negotiations stop, then even they will be much more impacted.
Absolutely, and G Chokkalingam sir, for all those saying that, look, how do we track? What sectors do we track now? We of course have seen the GST boost for our economy and markets. So for those wondering, look, in the midst of this GST boost, as well as now this positive signaling coming in, what do we do as far as what which sectors do we invest in? What do we track in the near term? What do we track in the long term? What would you say?
Certainly. I mean, I agree with our colleague economist. The impact will be very severe for certain sectors like textiles, petroleum product export companies, jewelries. So that's why the market is also quite smart. For last few weeks, those sectors were already punished by the market also badly. So this is the point I've been making for last few weeks, that ever since the aggressive tariff was imposed, I have been saying that to focus on the domestic demand-driven sectors. So that strategy continue till we see some clarity on the relationship between US and India, and reversal of this aggressive tariff. Till that time, one should focus on domestic demand-driven. So sectors like automobiles. There are many individual products and service themes which are catering to the domestic. apart from automobile, even the banking and financial. Their reliance on external economy is very minimal, almost insignificant. And so then you wait for the clarity. However, if there is any disruption to IT services, then the whole market will be impacted, because I don't think we have the capability to manage the stress coming. So that is where we have taken officially this morning a bold view that after seeing the gesture, that things can be worked out and there can be a rapprochement, because there are a lot of political compulsions for the US, not to antagonize India permanently. I may go wrong, but this is the stand I have taken. So till that time, focus on domestic demand-driven sectors and products, and also have at least 5% exposure to gold, 5 to 10%. Because if things go beyond our control, then the rupee will keep depreciating, and that will be positive for gold. That's what happened, 5, 7 years back. Even though the gold prices in the international market was stagnating for nearly 7, 8 years, Indians got benefited because rupee was depreciating every year 5%. So therefore, this will act as a defensive against any possible disruption further from the US economy to Indian economy, and therefore any possibility of rupee falling quite badly. So this should be the broad strategy, and also one should have a 40-45% exposure to Sensex and Nifty stock, because domestic institutions still have a lot of appetite to keep supporting these Sensex and Nifty stock. So these are the broad strategy I have been advocating for last 4 5 weeks, and one should consider that, I believe.
Yeah.
All right. Thank you both for sharing your thoughts. We will, of course, continue to track this space, India-US ties, as well as how all of this pans out for the global economy and equity markets, as well as commodity markets going forward. Thank you for sharing your thoughts. Thank you.
Thank you.
Thank you.